Cryptocurrency. It's either the future of money or the world's most overhyped bubble, depending on who you ask. Hey everyone, Tommy Derfler, Sam Rice here with the Lighthouse Wealth Group Spotlight Podcast. All right, today we are diving into cryptocurrency, what it is, how long it's been around, the controversies around it, how the government and the IRS are dealing with it, and the risks involved. So here's a quick fact. As of mid-2025, the total global cryptocurrency market is worth more than $2 trillion. Whoa. The question is, does it belong in your wallet, or should you leave it on the menu as something to admire from a distance? All right. So cryptocurrency, everybody's talking about this. There seems to be such a fascination around this. So, first off, we're going to talk about what is it. And basically, it's digital money. And it's, instead of being issued by a bank like dollars or euros, it's created and managed on what's called blockchain technology. So, which is decentralized public ledger that records every transaction. So think of it as like a large spreadsheet, right, that no single person controls, but everyone can see. So each coin is a record in that spreadsheet, and ownership is transferred by cryptographic keys. So Bitcoin, obviously, if you talk about cryptocurrency, most people are talking about Bitcoin, has a market cap of over $1.2 trillion today. Whew. But there are also more than 20,000 different cryptocurrencies floating around, which means, hey, which one should I choose? Which one's going to be around? Which one's going to vanish? And these are all questions no one knows. And so, at the basic of it, that is essentially what cryptocurrency is. So, Sam, tell us a little bit about how this works.
Yeah, good question. So we've got cryptocurrency, and it definitely differs than your typical bank transactions and ways traditional money is stored. And there's more or less 4 different ways that it really differs. First off is its transaction style. So instead of a bank verifying payments, which they do in between 2 transactions with a network of computers, these miners and wallets and exchange companies help validate these payments between 2 people, but there's no bank involved. So they're just help assisting essentially a direct person-to-person transfer in many cases of a cryptocurrency. They do the job. And then there's also miners that create more Bitcoin. So they are in the process of mining Bitcoin. And so they've got computers that help create a Bitcoin that can then be transacted upon. So there's a set amount of Bitcoin that can ever be created. So that also is very different than typical any country's currency. There's a set amount that can ever be created, which is very different. There's the verification ways in which these transactions happen. And instead of being bundled into a block, they are added to a blockchain. So they make, just as Tommy said before, every transaction is encrypted and recorded. So the security is also different too. These transactions are automatically encrypted between participants. So it's all available. The transaction is recorded, and which blockchain wallet owns which currency and which piece of it. But that transaction itself is automatically encrypted. So that's one of the interesting things, and how it differs from a traditional, say, bank wire or something of that nature. If you're making a bank transaction, there's no automatic encryption. And then the ownership. So these are owned in a very different manner than traditional bank holdings, bank accounts. They're held, the blockchain and the cryptocurrency itself is held in what's called a crypto wallet. So there's a couple companies that create crypto wallets for people. You can also essentially, if you are sophisticated enough, create your own, which is pretty interesting. And it's essentially like a private key to your own ATM that's held digitally and which holds the cryptocurrency itself. The tricky thing is that since there's no bank that's helping monitor any of these crypto wallets or accounts, um, if you lose your PIN or your password, you lose your money and your account.
Ooh.
So forever. So that's definitely one of the big differences. There's been numerous stories that I've heard over the last couple of years of people, some guy when Bitcoin was maybe $1, threw a USB drive that was his Bitcoin wallet away, and now, say he had 1,500 Bitcoin on it, wasn't really maybe worth much at the time, and now each Bitcoin's worth $100,000 plus. And so I think there's been a guy that has been recorded like looking for his Bitcoin wallet for 3 years. I think he finally gave up.
Goodness.
But yeah. So those are the four big ways in which they're very different than traditional currencies.
So no 1-800 number, customer support number to call and say, hey.
Yes.
Also, no FDIC insurance, which I think is really important.
This is true. Yep. Yeah. So, unlike we spoke about this before, one of the big differences between this and traditional currency is the ways in which it's transferred, right? A wallet to wallet transaction. There's no wire. And one of the interesting things is that if you sent a wire to somebody, you could contact the bank, just like you said. And if it was maybe fraudulent, you'd have FDIC insurance to cover you. You'd have the bank there as an intermediary. Here you don't. Once that's transacted from one wallet to another, there's really nothing you can do. There may be, some regulations that they're trying to put in place just with some of these cryptocurrency exchanges, where they're kind of the legal intermediary, so to speak, between wallets, but they still don't have much push and pull between these digital wallets because they're not necessarily they're encrypted. So even the exchanges themselves can't get involved in the transaction. So,
well, tell us a little bit about the history of cryptocurrency. Where and how did this thing start?
Yeah, so it was started in 2009 by Satoshi Nakamoto. And the interesting thing behind this origin story is that nobody really knows who this guy is. I think they believe he was a programmer in Japan who created this digital currency, Bitcoin, and nobody's seen him. He's never given like any big speeches about what he created. Wow. He's a mystery person. Yeah. Because at first, right, when this was created, it was very much a fringe thing to get involved with. It was trading just at cents. Essentially, it started at 1 cent, the value.
Wow.
And is now trading over $100,000 per Bitcoin. So in the last, about decade and a half or so, it's really come a long way. Over the couple of years that it's kind of developed, a couple other larger coins had also been developed called like Ethereum. Some of the newer ones are Solana. And these larger ones, as you spoke about before, there's over 20,000 different coins. So there's been some that have had more popularity that people really try and call stable coins, which have less volatility. There's a larger exchange market. And then, so in 2015, Ethereum was created. In 2017, Bitcoin for the first time hit $20,000. And then shortly thereafter plummeted 80%, because everyone was like, oh my gosh, it's $20,000. Let's sell everything.
Yeah.
And so you first saw that giant volatility there, in a huge scale. So it dropped 80% of its value. And then with all of these, big fluctuations in price in 2021, it hit 69,000. And then it also, shot back down in value for quite a while. And then in 2022 was the first time we had a large scale fraud with Bitcoin. So we had the FTX story, which was essentially a Ponzi scheme where the company was creating their own digital currency and scamming everyone that had purchased it. So they'd created their own company as a digital transaction storage and wallet creation company.
Huh.
But yeah, the SEC had to get involved, and it got really sticky, and a lot of people lost a lot of money that held their wallets on FTX that they later found out were just essentially getting their money embezzled from them. So
where is the price of Bitcoin today?
Today, it's around
Roughly.
115,000 per Bitcoin.
Wow.
And last week it hit, maybe it was an all-time high, pretty close, but about 124,000 per Bitcoin. So it's definitely come a long way from its infancy.
Yeah, no kidding. Interesting.
And right, this is one of the reasons why it's, people try and use it as a speculative currency, get behind it. It's decentralized. Why is it so special? Well, it's got these crazy price fluctuations, which are seductive to, I would say, maybe more inexperienced investors and just people trying to take advantage of that situation.
Yeah.
So how is other ways that this has really become, a bit different or polarizing than traditional assets, you'd say?
Yeah, I mean, the people there's two camps, right? There's the one camp that are 100% believers. They say it's the future of money because it is very futuristic. They say, hey, offers a hedge against inflation because I think you mentioned earlier, you can't make any more of it. You can't take away from what's already out there. And it's a way to take financial power away from, centralized banks and governments. And so, that's what one camp says, the believers, and they believe in it. And then you have these skeptics over here that say, hey, we don't know enough about it. It's, too volatile, too unregulated, which we'll get into, and too often a playground for scams. And so, you've heard of, a lot of cryptocurrency is used in the black market, where you sell things and buy things illegally. And you hear of terrorism and terrorists using cryptocurrencies and so on. But, if you look at the numbers and the stats, there's numbers that highlight both sides and both camps of this. And it looks like here in 2023, illicit crypto transactions reached $20.1 billion, the highest on record. But at the same time, more than 420 million people worldwide now own cryptocurrency in some form. So, I think the controversy boils down to, is crypto a revolutionary technology just messy in its early stage, or is it destined to remain more speculation than substance? And that's, the part that we don't know. So if we look at this, obviously, you and I get a lot of questions around cryptocurrency, whether, people ought to own this or not and to invest in it. Well, you got to really look at the risks first. Anytime you evaluate any type of investment, you always want to look at, hey, what's my worst case scenario here? What could really go wrong? And start with that. And so if you look, just purely at volatility, Bitcoin lost 77% of its value between late 2021 peak and its 2022 low. If you look at the S&P 500 during that same period, this is really interesting. The index dropped about 25% before rebounding. So you had a decline of 77% of Bitcoin during that same time frame, and only a 25% decline in the S&P 500. So, the S&P 500 has averaged annual volatility of around 15% over the last 50 years. If you look at something like Bitcoin, their annual volatility is often above 70%. So that's not riding a roller coaster. That's more of a rocket ride loose bolts, on there. But, the other thing is security. In 2022 alone, hackers stole over $3.8 billion in crypto. And once gone, there's no bank to make you whole. Like we talked about, there's no 1-800 number to call and say, hey, I really need to get this fixed. That's it. It's a done deal.
Yeah.
Fraud, obviously, from Ponzi schemes to rug pulls, scams are rampant. FTX was the largest, but far from the only one. And then you have also at the same time a lot of regulatory uncertainty. So, all of this is unraveling before our eyes, and the government, which we'll talk about here in just a minute, is trying to figure this thing out as it already exists. A lot of times somebody may have an idea, and then a lot of government regulation will come in to have time to figure these things out, to say, hey, how do we propose this? What do we do? Well, cryptocurrency is already there, and so with regulatory uncertainty, what's legal today could be banned tomorrow, and it's unraveling. And so they're trying to figure this out as this is already ongoing. But, I think anytime, again, you evaluate any type of investment vehicle, you always have to look at the risks involved. And I think one of the biggest mistakes a person can make is jumping into something, regardless if it's cryptocurrency, and, buying something they don't really understand or they haven't done their due diligence on. And so, that's one of the mistakes I find with a lot of people, is just diving into anything without really knowing or understanding. And so, if you look at Warren Buffett and Charlie Munger, they'd always say, hey, we know and understand the companies that our money's in. And Charlie Munger, once said, hey, we invest in companies we understand. We invest in things we know. We do not understand cryptocurrency. We do not understand, I think he said Bitcoin and blockchain technology. And so
it's a place.
Yeah, they didn't know that. And so they didn't invest in those things, for that reason. And so, people tend to look at the flashy side of things and see, the upside, and see what people are talking about, and sometimes headlines, without doing, their due diligence and saying, hey, what is this thing? And, sometimes people can do that and say, you know what, I still believe in this. Great. At least you've done your due diligence. The risks. This isn't a black and white issue, right or wrong. It's just knowing what you're really getting into. And so, you really got to reevaluate, or not even reevaluate, but evaluate the risk going into this, because I think for somebody who's young and maybe not as experienced investor, diving into this is like not diving into the deep end of the pool, but diving, in the ocean, where there's no coast anywhere close, and that would
That's
be
right.
my analogy in that. And so, you just got to be really, really careful on that. And so it's just a little bit like the Wild West. So again, there's just a lot of risk. There's a lot of volatility. Anytime people say, hey, this is the best thing since sliced bread, you got to be careful. You just got to know what you're getting into. And another analogy I always use is, if you ask anybody that likes to fish, hey, tell me your best success story, they're always going to tell you about the fish that they caught that was super big, and they went out in the lake or the ocean and they caught right away. But what they're not telling you is how many times they went out there, got sunburned, were out there for 5 hours at a time, didn't catch anything, came back home with nothing.
All the skunk stories.
Yeah. So with that, we want to make sure people are aware of those risks that come along with it. So, but, going to government regulation and taxation, talk to us a little bit about the IRS and what they're thinking about this and how they're kind of approaching this from a tax standpoint.
Yeah, good question. So the IRS, right, they're playing a little bit of catch up. This is new, it's intriguing, and it really hadn't caught too much popularity until the early 2000 teens. And for the first time, in 2014, the IRS classified cryptocurrency as property, and that therefore, in their eyes, it needs to be taxed. IRS loves to get involved and tax anything they can, so it's neither here nor there. But it's just one of the ways in which they can also track some of these transactions that are going on. And so just like any other property, if you sell crypto in the eyes of the IRS, that is considered a gain, and capital gains tax that applies. So although we're not tax experts here, work with your CPA on any transactions of cryptocurrency you may be involved with. But just to be aware, they do look for it. It is being recorded now. And as of 2020, there's also now on the 1040 a indication where you can start to monitor and divulge your cryptocurrency transactions on your tax return. Again, if you're exchanging one currency for another, that's taxable, right? It's essentially, in their eyes, exchanging any currency for another. No different if it was one country's currency for another country. Crypto is just the same. And then if you're also, one of the other ways in which cryptocurrency can be used to earn income is if you're mining it, which is one of the ways new cryptocurrencies and or Bitcoin are discovered. They're essentially what's the best way to say it? They are
undiscovered.
They are discovered or unencrypted, because there's a certain amount of Bitcoin that will ever be found or created, but people have to find them. Essentially, it's called mining, and then they sell the coin once it's been mined. But that is also, people will get these giant computers set up, take up whole rooms to mine for Bitcoin and or other coins, and then sell them. And so the IRS has recognized this as a form of income and has now started taxing that as well. Because once you sell the coin for a profit after you've mined it, that's now considered ordinary income. So the IRS is starting to get involved. I think they're still probably behind the ball trying to record all of the wallet transactions. And that may be always, a catch-up game for them.
Yeah.
But I think it's helpful because it puts, not that I'm all for super regulation of, securities or, the government getting too involved in everyone's day-to-day business. But, it's really another way where they can start to protect individuals from fraud, I think, right? As we were talking about, hackers stole $3.8 billion. One of the big detracting points that people have used for any coin transactions or the use of them in the past has been the fact that there's no banks involved, kind of being the referee to make sure that illegal transactions aren't being done. So I think, right, if there's an IRS track, that's just another way that you can catch those and kind of help people be on the straight and narrow with their crypto transactions, if you want to put it that way.
Well, what I hear you saying is basically that the IRS, they're going to want to know, no matter what, if you're dabbling in crypto.
Yeah, and it's another, right, we've got the regulatory environment of the SEC, which monitors actual investable assets, and then there's the IRS, which essentially monitors the taxation of income and people making money. So they want to know, right, if somebody made $20 million all from cryptocurrency transactions, essentially let's just make sure that's all legitimate. And I think that's fair.
So moving from the IRS, because what I hear you saying is they're not going to be free lunch. They're going to be all on this, and they're probably just they're having to play or make up some time here, right, to figure this stuff out and stay ahead of that. Yeah. But tell me about government regulation. I mean, obviously, the government wants to know more about this as well. What are they doing to help protect investors?
Yeah. that's the other key component, right? We want to make sure this is safe for investors, want to make sure that people that are investing in it are protected in their transactions, in the ways in which they store their cryptocurrency, which would be your crypto wallets. And so the SEC's got involved to just try and put some type of guidelines in place. Because, right, if there's 20,000 of these currencies and any group of programmers can really get together and create one, they really want to help protect people from, um,
Themselves.
bad individuals. Yeah, protect them from themselves and groups of people that may be working in nefarious ways to create a coin, pump it up, and then sell everything and just get out and skate into into the sunset.
Okay.
So, yeah, so they put into place Treasury Department put into place crypto exchange regulations to know your customer and the Bank Secrecy Act.
Yeah.
So just like us, we have to know where the funds of our clients came from. They have to know where these accounts are originating from, and these funds are also coming from, just like we do. And just like banks, they're trying to instill at least some level of transaction regulation, not trying to get in the middle of it, but having some clarity so that these crypto exchanges know where their clients' funds are coming from.
Of course.
So, it's nice that in a way it is very much decentralized from any large government. A government can't just print money and essentially devalue the currency. You can't really do that with any of these coins. And it's increasingly becoming more popular. So people and regulatory bodies just want to help protect the retail investor from other nefarious actors, but also themselves getting involved in something that, as you said, they may not know too much about themselves.
Yeah.
So,
well, I know the Federal Reserve talked about, having a central bank digital currency, which is a digital version of the US dollar. And so, there have been a lot of ideas and thoughts and conversations around that about, okay, hey, what if the government can start doing this to some degree to, kind of create this hybrid model? And who knows where that's going to go. But, I think the biggest thing is having, and I'm not huge on government regulation, but I think in this situation, I think having that regulations there is really there to help investors protect themselves from themselves. And one thing I think a lot of people don't know is that as advisors, you and I were also regulated. And so, custodians,
very much so.
The Charles Schwab, the Raymond James, the Fidelities, the Pershings, and these other places that hold people's monies, they're coming out with their own version of these things and what they feel like is okay for advisors to do and not do. And that's up to them. So for us as advisors, we get this question a lot is like, hey, can I own this? Can I own this? And it's like, hey, this is still the Wild West. We're being protected too. Because the last thing, I think any advisor wants is to be able to give something to somebody that they want. And then all of a sudden it didn't work. It worked against it. And now it puts the liability on the advisor as well. Yeah. And so there's protections around, everybody that basically has a hand in this to say, how do we do this to where we can balance the needs of what people want, but also making sure we're protecting people against themselves as well. So,
very good point.
But, I think just to recap and summarize here, cryptocurrency, is digital money built on this blockchain technology. It's very futuristic. It's very flashy. It's very intriguing. And it has grown from this obscure idea back in 2009 to this multi-trillion-dollar market today. And so it's created wealth, it's fueled scandals, and everything in between. But I think, for today's podcast, the biggest thing is this is, very rarely investments is things right and wrong, good or bad, black and white. It's what's best for you. And so the biggest thing we want to convey is just, there's always a risk to anything where you decide to put your money as far as an investment goes. Anytime you earn anything, you've got to take some level of risk, even if it's a very, very small amount. So going into this idea of cryptocurrency today was really just to give education and say, at the end of the day, do your due diligence, make sure you are doing what you feel is right for your long-term plan, your financial goals, and so on. But
that's right.
With that in mind, thanks for tuning in. Please like and subscribe. We appreciate it, and we will see you on the next podcast. Tommy Derfler and Sam Rice, thank you very much.
We'll see you then.